session brings a new faculty member from the media to us. Soma Biswas is the private equity head at DebtWire, part of the Merger Market Group. And while most often we can find agreement on where the opportunities are not, we can rarely agree on exactly where the opportunities may be. But we couldn't think of a better group to assemble with representation from the private equity community, corporate community, the advisory community, and from one of our favorite resource centers, S&P Capital IQ. So, Soma, I think I'll turn the floor over to you. I know, like Alex, you are over-prepared and with a tremendous amount of distance to cover in a short period of time. I wish you good luck.
Hi, everyone. Welcome to the panel. We're going to be talking today about where the opportunities are in distressed debt investing and in distressed M&A and turnaround investing. I just want to introduce the panelists. Larry Laddick is at Mesero Financial. He advises creditors and debtors in fairly large Chapter 11s. Bassem Mansour is right next to him. He's the head of Resilience Capital, private equity firm, and Duncan Bourne is with Winchurch Capital. And then we have Shaya Hosseinzadeh, who heads up energy investing at WL Ross, sorry. And Pavle Sabek is the head of market development at S&P. And then we have Dirk Savini, head of restructuring at Peter J. Solomon. Welcome, gentlemen. I'm going to start off by asking about what the opportunity set looks like this year for both restructuring and debt investing. For the last 2 years, all we hear about at conferences and from just talking to people in the industry is about complaints about the dearth of opportunities in restructuring given the low interest rate environment and the robust debt financing markets. So I'm wondering if this year is looking any different. Duncan, do you want to start off?
Sure. I'll do my bit here. So I'm, except for oil and gas, which we've heard a bit about already, and I think we're going to hear more about. I think that this year is going to be about the same as last year in general. I think there's a couple reasons for this. One is that the economic indicators are pretty strong. Everything except for housing seems to be up. The credit markets are still relatively easy. Amending covenants and extending maturities still in vogue, and also many leveraged finance transactions in the last couple of years have been getting done with little or no covenants. So I think that is a pretty big factor still. The ubiquitous maturity wall, well, it doesn't really exist. It always seems to be off in the future sometime. You never actually hit it, and it's several years off if you were to take a look at it that way. I'm told that banks are losing some patience for smaller troubled credits, but there's plenty of non-bank finance companies out there stepping in to service the lower end of the market. And in the middle market, I think that banks are still willing to accommodate borrowers when they're trying to pursue alternative financing or where they're looking for a sale. And the market's been very cooperative with very high prices, high debt multiples for deals that are being brought to market. So higher debt equity is now on offer even higher than pre-crash. I think you could look at statistics that show you that. So I think along this vein, I think there's plenty of loan-to-own opportunities if you sort of think of these as folks providing debt financing to companies that are already in pretty highly leveraged situations. If there were to be a turn in the economy, that would sort of turn into a loan-to-own situation. So I think also that that in those situations where it's proving to be difficult to refinance or to sell the company, I think you're going to see an increasing tendency among banks to sell their positions. And I think that so special situation investors, I think, should be seeing a reasonably increasing level of activity. Not huge, I think a lot of the activity is going to be in oil and gas, but I think there's going to be some increase in activity there. And then on the distress control equity side, which is part of what Winchurch does, about a third of our deals are out of distressed situations. I'm not expecting a huge uptick in opportunities, but I do expect an increase, towards year end. I've heard various rumors about Professor Altman and what he thinks is going to be happening in the next 18 months or so. And then those other opportunities where there are, operational challenges in the business, it's tough balance sheets, a tough operational situation, which is a lot of what we do. Those deals will continue to arise across the economy. And so I think that we're seeing more of those actually as the economic rebound since the last crash has continued on, and we're seeing companies a little bit longer in tooth, seeing a few more operational issues than they've seen in the past couple of years.
Okay. So it sounds like you're seeing you expect to see a little bit of an uptick in opportunities, especially towards the end of the year. Dirk, did you have you have a good bird's eye view on
Look,
restructuring?
I think that Duncan's characterization of the market dynamics that we're facing in 2015 are spot on. What I want to do is just, I guess, unpack from a sector target perspective the areas that it's not going to be surprising to any of you. I agree, oil and gas is out there. Everybody's focused on it. It's like there's this giant sucking sound, and it's everybody running over to try and grab the oil and gas guys and go pitch business. Frankly, I think that that's early stage from a restructuring advisor perspective. There's great investment opportunities if you're an investor. But if you're a restructuring advisor, I guess I question whether or not there's going to be a lot of that activity, at least in the first half of the year, probably in the second half of the year, more likely. Doesn't mean you don't go out and grab clients. It does mean that in the short term, there's not going to be a lot of revenue-generating activity. The other sectors I like to break down is into larger groups, what I call the secular challenge sectors. Retail and apparel is one of those, old media. There's still a fair amount of activity out there for some of those companies. The difficulty with that sector, or that segment, or those sectors, is that you have to ferret out what's reorganizable and what's not, what can be restructured out of court and what can't. Sometimes you'll get involved in these situations, you'll think that there's a going concern restructuring, and it'll slip through your fingers and you've wasted a lot of time. So it's important on the front end, if you're an investor or if you're an advisor, to make certain that there's a there there. The other area I would just say is kind of an extension of oil and gas. It's commodity-oriented sectors. It's pulp and paper, mining and minerals, and coal and iron ore. There's still a fair amount of restructuring activity in some of those areas as well. Just to add to the regulatory comment that Duncan made, you're probably all reading about the leveraged lending regulations that are coming out. They came out, I want to say, in 2013. The banks didn't pay attention, and they got their knuckles rapped last year. And now they're in a situation where they're all being very careful about originating what are called no-pass credits. I think that's going to have an impact on liquidity to some degree, probably more at the margin for leveraged credits this year. 2014 wasn't as prolific from an issuance perspective as 2013. It's likely, and I've seen S&P has even indicated that they think it's 10 to 15% down from 2014. So part of that, I suspect, will be related to those leveraged lending issues.
Sure. I'll chime in on this since you mentioned us, right? Thank you for that. I completely agree with what's been said so far. 10 years, actually, it's been the least amount of defaults that we've seen. If you do look at the data, however, it looks like the counts are down, but the number is up. But then again, it's all about energy future holdings, right? They blow everything out. So even if you look at the leveraged loans, for example, the 12-year lagging leveraged loan default rates, when energy future holdings, when that is extrapolated out in April, that's going to significantly drop, the default rates there as well. And it goes back to what you were saying before. It really is to do with the dearth of maturities that we're seeing in 2015. There's hardly any of them, like below a percentage point. And we're also seeing, there's a lot of cash that these corporates are having and are hosting, and it's increasing more rapidly probably than the kind of debt to EBITDA levels that we're seeing. And in terms of the sectors, industrials is probably the biggest default of last year if you take out utilities, so if you strip out energy future holdings. Consumer discretionary is always a big, count as well as value. Within there, I've seen a lot of actual kind of catalog retailers, right? So if you look at some of the retailers that actually specify, and they're still doing, paper distribution of catalogs, they've actually been defaulting quite significantly. At least their probabilities of default in 2014 have elevated quite a lot. So I think it's important to look, also the business channels, and it's important to look at, which maybe we have time for later on, and look at the supply chain of some of these really big companies like Apple, like any e-commerce companies, to look at how they're actually going to transport these retail goods they're talking about, and who's going to supply them as well. And that's very important.
I think the other area that, as you think about industries where there are you're seeing a fair bit of activity, or where we expect activity, we've seen also a little bit on the corporate divestiture front. While not industry specific, larger corporations that are seeing more activist activity in the stock and more of a focus on assets that are providing an adequate return to the shareholders is forcing, in some cases, corporate boards to shed assets, while not traditional restructurings, more underperforming businesses that are operationally challenged, that are difficult, are complex, again, that aren't providing adequate returns for shareholders, are creating a bit of an opportunity. And albeit, as we see some of these opportunities, they're somewhat disparate assets coming out of larger corporations. So in some cases, not even a traditional operating business. It could be a group of assets that doesn't have a traditional administrative structure associated with it, may not have a traditional management team. So in that case, they evolve into more operationally intensive restructurings. And we have seen of late, particularly over the last 24 months, a bit more activity on that front.
Yeah, so sort of a turnaround, but without the bankruptcy side of it, right?
Mm-hmm. Absolutely.
And okay, and I want to ask, of course, about energy, which other panels have discussed. But Shai, I just want to start off with you. The real question is how much distressed energy investing opportunities are going to see, how much restructurings are going to see, and when. How soon are we going to see that?
Sure. So let me just kind of go back to some of the comments that were said earlier. I think if we were sitting here about 10, 15 years ago and we're talking about distressed deals, I think the holy grail for all of us in the investing business is to find good company, bad balance sheet. That historically has been what has made this asset class so terrific. When you listen to some of the panelists before me, it seems that distress, given the amount of inflows and the default rates being 90% lower than where they were about 7 or 8 years ago, has really evolved to kind of include companies that are challenged, and you take the challenged balance sheet. So for us, when we look at the sector, and I'll come back and answer the question is, at what risk premium are you getting paid for some of the complexities that come with those businesses? If you think about energy, that's the one sector right now where we're seeing a dearth of opportunity, where you actually can go after the classic, good company, bad balance sheet structure. So to talk a little bit about the anatomy of the cycle, in the last 10 years where we commercialized tight oil and shale gas production, the sector has gone through a bit of a super spike, if you will, on the M&A side. We have closed just shy of about $750 billion of asset deals just here in the U.S., and most of that has been financed with the capital market. So there's been about $500 billion of capital market issuance in that same period of time. If you fast forward to today, a lot of those are good assets. They're just not profitable at $50 oil. So when you fast forward, 6, 12 months from here, there are a number of catalysts that we think unlock deal flow, which for the last 6 months haven't been there. The first is that you're going to see the sector, see the impact of hedges rolling off. So that'll have a real material effect and will cause a number of people to come to market. Second, this is a sector that's been extremely dependent on the capital markets. $50 billion last year when oil was at 100. We estimate that number's closer to $120 billion this year with oil being at 50. if you think about any segment of the market that needs to issue $120 billion of new debt, when the high yield index in that sector trades at 80 cents, that'll be challenged. So that for us is a wonderful signal in terms of the quality and types of transactions that you can do. As to the actual supply of deal flow, we think right now the best opportunities are in credit. We haven't really seen the default rates. Default rates are a little bit of a lagging indicator, but the leading indicator for us are if you look at the EBITDA, debt to EBITDA levels, and if you reset that at current oil prices, the sector, unless you believe oil goes to 75, 80, is not sustainable and is going to wipe out a lot of equity. So that's where we see really the ground zero of activity in the next 6 months.
I'd like to speak to that if I can. I'm from Texas, a state that was founded on, remember the Alamo? And we do, we just have a hard time remembering that oil's going to drop below $100 a barrel. And every time it does, we end up with a panic. If I had a distressed fund, I'd be out buying all of the oil supply companies that I could get because of the simple fact that it always comes back. You know, it's 27 degrees in Dallas today. It was 70 on the weekend. And there's a saying that says, if you don't like the weather in Texas, come back tomorrow. And that's if you don't like the price of oil, come back tomorrow, because it's either going to be up or it's going to be down, and it never drops below $40 a barrel, so you can ride that thing back up. And I think the danger, though, in buying debt is that you become an unplanned loan to own, where you made the loan and now you own it. I think there are a lot of those risks out there. So I would go along with the good company, bad balance sheet, but I find it hard to find too many E&P companies that don't have bad balance sheets, because the debt was available and they took it.
We can have a drink after the panel. I'll give you
Well,
a few ideas.
you know, Texas is the only state where specifically you are prohibited from taking a second mortgage on your house for an oil investment. They won't give you one because that's what people used to do. You know, we'll go take a second mortgage and we'll drill a well. And those people that made money in those days are still out there, and they're still waiting to make that money.
Well, I think for us, I mean, the way we think about it is that as an equity investor, unlike maybe a distressed debt investor thinking about the energy sector, part of it depends on duration. I mean, to your point, obviously, it's cyclical. So depending on your horizon and how long you want to participate in the sector, it may lead you to a very different conclusion. Participating as an E&P guy may require you to have a much longer duration than somebody who wants to participate in the supply chain on the drilling side. So there's different segments. Energy is a big word. There's lots of different places you can participate. Some look and feel more like real estate investing, whereas others are more of a traditional manufacturing investment versus a service investment. And for us, with a traditional private equity fund structure, our duration is somewhat predictable. Not exact, but we then call it a 3 to 7 year time horizon, broadly speaking. And so that leads us to a certain conclusion that the E&P side is not for us. Participating more maybe in the supply chain, something that's a bit more predictable, is for us, while volumes and pricing of product, depending on where you are, may vary. You do have a little bit more predictability.
Yeah, and I'll just add to that. I think when you do look at what's different this time, and every distress cycle, somebody says, well, it's different this time. There is something that's truly different this time, and that is that if you went back to the 1980s, and people talk a lot about the 1980s, U.S. production was in secular decline, and the model of pulling it out of the ground was conventional drilling, so your odds of success were on average 1 in 12. Fast forward to today, we are set to become energy independent and one of the top energy producers by the turn of this decade. And the success rate in shale is 99%. It's a statistical game. So that sets up, I think, and Bassem, to the point you were making, it sets up for some very interesting secular themes if you want to play that rise in production, which we think is inevitable. And also, to the comment that was made earlier, this is a market that globally is $1.6 trillion of face value. Even 30% of that market is substantial relative to the private equity money out there. And that's fundamentally an asset class where you have predictable rates of return operationally, and it's a cost game. So that bodes very well for private equity ownership.
I just want to jump in with a question. So Bassem and Shai, you're both talking about, production's going to pick back up, but what all the headlines are telling us is companies are cutting CapEx and cutting production. And then that goes to the larger question of how do you avoid falling knives in this segment right now, in this sector? And I would think that the equipment providers they're the ones that are, and drillers and servicers getting hammered the most, probably the diciest area to play in.
Well, but servicing an existing well has a different dynamic than drilling a new well today. And part of it, again, it depends on where you're going to participate. Certainly there is changing dynamics with reduction in price and demand for drilling new wells. So again, I think it comes back to if you're on the service side with existing production versus on the exploration side drilling new wells may lead you to a different conclusion depending on how long your time horizon is. If it's a bit shorter, you may not have the tolerance for waiting out for drilling new wells.
I think if you step back and think about investing, what we do is we invest in management teams, we invest in companies with great strategies, great positioning in their markets. And so when you're investing in these businesses, you have to sort of divorce yourself from the oil price background. You have to think about the business that you're investing in. And then if you like that business and you like that investment, you then have to say, okay, at what price of oil do I like this company? And when do I think that price will come back? And you have to undertake some risk. This is a distressed environment. You have to undertake some risk that price isn't going to come back for some time, or that it may never come back. And if it doesn't come back, well, then you'll lose your investment. But if it comes back and you have the right team and the right management team and the right company and the right strategy, the right positioning, the right customers, and you're able to control your costs well, you'll do well in your investment.
So I'll speak to one of the pitfalls here, because I think, energy is in some senses as specialized as an industry as you're going to get. I think somebody used the real estate analogy. I think that's absolutely true. But the difference is, in real estate, if I were to show you a portfolio in California, you could easily say, well, this is beachfront Malibu, this is downtown LA. You can see that. There should be a price difference. In energy, the stuff's under the ground. So unless you have technical capability, it's very difficult to draw that line. And yet the value demarcation is probably even more significant. So the one thing, Soma, that I'll put out, because I think most people who write about the sector seem to miss this, energy companies are melting ice cubes. That when you buy into a portfolio of E&P assets, it has a natural decline rate for shale that ranges from 20 to 40% depending on where you are. The relevance of that in today's environment is, if you're of the view, and we do a lot of fundamental bottoms-up work at our firm to develop our view, but if you're of the view that oil is going to be depressed for a 3-year period, these companies are going to be liquidating their best assets to pay creditors in that 3-year period. And so your residual value, year 4 and 5, oil might be up 80, 100, doesn't really matter. If you're out of inventories of good locations to drill, that can end in a very negative recovery for equity or for whatever the fulcrum security is. That's something that I think where most people, what you talk to in the market today, don't really pay enough attention to.
So it sounds like you're saying you have to have a view on where oil is going to.
I mean, it's a commodity business. It's impossible to invest in a commodity business. And having a view is one thing, but at least not knowing, where the fundamentals of supply and demand intersect over a 4-year period is critical. The other thing with energy is if you're not buying a high quality asset, there's very little that you can do 2, 3, 4 years down the road.
Larry, I think you.
I agree. I think you're not going to get hurt buying Halliburton or Schlumberger. Those are unfortunately the first people hit with a downturn, but they're also the first people to come back. And if you're looking for something that's more in the realm of reality, because those companies trade at huge multiples, probably a supplier to either one of those is a good investment. Somebody that's been supplying to them for a long time, who temporarily is in some distress because of the lack of new equipment being bought by Schlumberger, who's in turn going to put it out in the field. I think those are probably good investments at this time.
I just want to get back to some of the other sectors that we touched on, that the panelists touched on. Does anyone want to speak to what's going on in the retail sector? Dirk, I think you mentioned that that's going to continue to be an area where there's going to be some restructurings and turnaround investing opportunities, or perhaps just restructurings?
It's the same old story, and to some degree, it's a sector that is in I'd say the early innings of a secular restructuring. The challenges, to a large extent, have to do with e-commerce and omni-channel strategies that are intruding on the profits of the large brick and mortar retailers, and that plays out to a lesser or a greater degree depending on which segment. So, in particular, consumer electronics is one area that's hurt. Apparel, particularly teen apparel, you've seen got routed in the fourth quarter. And that had to do, to some degree, with some of the problems that's going on in the mall area. Some of the B and C malls are starting to approach an area where they're getting to, because of the vacancy rates, dead mall status. And so you have one thing, you got teenagers who are less brand focused and they shop online and across platforms, and they also don't show up at malls anymore. And so there's some of those challenges as well. So it's hard to say across every segment within the retail sector that there's going to be restructuring activity. And as I said earlier, the restructuring activity may just be orderly liquidations.
Yeah, I think it's a misnomer to call it restructuring. Seriously, I have not seen a retail company get restructured in a long time. And it has to do with some of the bankruptcy laws, since we talked about that this morning. You got to make decisions on your store leases right away. And the secured debt holder is looking at it and saying, I've got 10 more teen retailers that have all filed and liquidated. I'm not going to play this one. It's much less of a hassle for them. It's the de-retailing of America, if you have bought into that theory, which I think is been written about in some books, that at some point we've got to de-retail. You can't have everything available within every 5 miles, and I think that part of what we're seeing there is that I only know of, and perhaps I'm way off on this, but I only know of one online retailer who's wildly successful. But everybody's going to close their brick and mortar stores and go to online.
See, I don't think it's quite that drastic. There is a misnomer out there that e-commerce represents a large share of total retail sales. It's wrong.
Yeah,
right now it's about 9%.
It's wrong.
It's about 9%. And so there is going to be a relatively large embedded investment in brick and mortar. And it depends on the segment whether or not it's going to be profitable. Because discounters are under far less attack than Best Buy. And so those guys are having difficulty. Now they've had some relief. One of the big four, people refer to the big four, at least some of the people in the distress sector. Last year the big four was Sears and JCPenney and Radio Shack and Toys. One of those guys has succumbed. And so now you got a big three. But you know, the J.C. Penney you've seen has come back from the brink. Now, whether or not that's sustainable, it's questionable. But there are going to be large, big box retailers out there in certain segments for a very long time.
Yeah.
And then other sectors that we're looking at, and you know, we tend to look at our businesses that people are kind of running away from because that's where we think there's sort of that contrarian investment opportunity. So businesses or areas that are in decline still, agriculture or ag equipment, things like that are things that we're looking at. And we see a fair amount of military defense businesses. There's still some after effects from sequestration, depending on what weapons system or equipment you're talking about. That's still happening out there, and there's still good opportunities there that we've seen recently. And then mining equipment, that sector is an interesting area. It's like it's servicing a commodity industry just like the oil and gas sector, and it's somewhat related, and so you'll see some rebound there, we think. But right now it's in tough shape, and also heavy construction equipment. It's also going to get affected a lot too with the oil and gas sector as well. So we look at those as potential good areas to invest in.
Pablo?
And I think we're all kind of touching upon early warning signs, right, in terms of malls shutting down, in terms of EBITDA levels. And sometimes when you're looking sector specifically, you tend to be a little bit kind of myopic or even kind of blinkered. So what a lot of our clients are doing are looking at the elevated probabilities of default, both from a kind of equity standpoint when you use some fancy quantitative Merton models, and also look at some fundamental indicators that go back to probabilities of default. And a sure-shot case of that was GT Advanced Technologies, who were with Apple, and they pretty much banked their entire business on the new Sapphire screens, which got many people, excited. There was a very interesting case study that went on there without going into too much detail. Apple actually gave them the money to make the furnaces to produce the Sapphire screens. They lent them the money which their balance sheet couldn't handle to begin with. So 2 years before the bankruptcy, we were showing that they had elevated probabilities of default for their fundamentals. If you're looking at just on a kind of glancing it sounds fantastic and it's a sure shot win, but actually, now they're in bankruptcy and they have been in the past several months. They're trying to extend it to figure out what they're going to do with their patents. So just to emphasize the point, I think there's a variety of different early warning indicators, and I think looking at the PDs and looking at fundamentals is very important. And the previous panel, they actually said that their clients are looking 1-2 years out, and this is exactly what happened with GT Advanced.
Okay, and I'm also, just getting back to retail for a moment, a few of you, I think, talked about how a lot of these are going to end up in liquidation, and I'm wondering if that's just because the retailers that have restructured, a lot of the ones that have restructured in the past 2-3 years are small, relatively small. They're not Kmart sized deals, and do you agree with that thesis? And do you expect to see those large restructurings in, I'm not going to say the next 12, but let's say the next 18 months, restructuring or turnaround investing opportunities in the likes of Toys R Us or Sears?
I don't know. Straight away, I'm thinking about activist investors, and I think, when it comes to these kind of restructuring and these kind of highly kind of controversial takeover bits, there's a lot that's happening there. And I recently did a report on hedge funds, and in hedge funds, it's an interesting indicator of what's going on. They actually bought heavily into energy last time around. They're not really buying up too much into retail, but they are going into financials quite a lot. And when you look at someone like a Pershing Square Management that only has 9 positions, and then they buy, Restaurant Brands International, right, which is Burger King and Tim Hortons. Boy, that's a lunch. You kind of have to start looking at those positive signs, but then also where they're exiting. Why are they going out of healthcare? Why are they not favoring activists and these big guys? In terms of retail, I wouldn't know apart from the catalog retailers, which I mentioned before.
Well, part of it has to, sorry there, but part of it has to do with the motivation for the restructuring. There are some retailers that have liquidated that have simply a broken business model. And when you look at the competitive landscape, they didn't have a differentiated strategy, and it made sense to simply liquidate the inventory and walk away from the obligations. In other cases, it may be, even as Dirk was mentioning a few minutes ago, a bit of a real estate-oriented strategy, depending on where they are, locations, leases. In many cases, that, as we all know, plays a very big part in restructuring for retail. So, some of it, putting aside the very large cases, the Radio Shacks of the world, in more of the middle market oriented situations, I think the investment thesis and where people are going to be, where investors are going to gravitate, again, is going to depend on the motivation for the ultimate restructuring, whether it's a broken business model, it's a real estate strategy, they're trying to adapt their business model and create more of an e-commerce presence, maybe not entirely, but in part. So it's probably not the answer you're looking for. We're not specifically focused on retail, but it's what we've observed.
But there are pockets of success out there where I understand that empirically it's true that a lot of these teen apparel retailers are small, and a lot of them in a short period of time filed and liquidated. Some of them are still going through the motions of trying to do some type of going concern to see if that can happen. But there are not an equal number, but there are a small but less talked about number of success stories where an apparel concept like Avenue, which is a plus size woman, that was sold by Keurig to Versa, and they did a tremendous job of turning that around. I think they recapped it or sold it, but I mean, here's a situation where you don't have a busted business model. It was just a management issue. And so it's not every one of these situations are going to ultimately go in that direction.
Okay. Since we only have a few minutes left, I just want some of you to talk about how the restructuring environment has changed in the last 10 years. Larry?
Yeah, that's, I laugh because I was thinking back to, I did Kmart, as did one other person in this room who probably doesn't want to admit that he's that old. But that was a restructuring. The last time I saw a bankruptcy filed that was a restructuring, an actual restructuring, was probably American Airlines, which started out as a restructuring and then became a deal. But I think it's the advent of the debt traders, et cetera, that have forced all of these things into liquidations or immediate sales or whatever the situation is. You don't have time to put in. They don't take the time to put in new management to figure out how the business works. What they take the time to do is to sell it to somebody else and make it their problem, whether it's inside bankruptcy or outside bankruptcy. We're going to sell this business, we're going to downsize it, or we're going to liquidate it. I think that's what happens.
Yeah, there have been a couple of really, I think, landmark developments in the market in the last 2 decades that I think maybe speak to some of the trends you were talking about. I think number one, the supply of distressed money has mushroomed. So what that means is that what historically would have been a high teens rate of return for a distressed situation is now lower, but it also means, and we saw this in spades in 2009 and 10, is that the only venue for restructuring is no longer bankruptcy. You can kick the can down the road, you can look at Freescale, you can look at Harris, you can look at Realogy. There are so many other examples where the combination of a lot of money, fewer covenants, the bank market plays a much less significant role. You have the silent second liens, combined with a very willing base of lenders to step in outside of a bankruptcy has been, I think, a huge part of reducing the number of bankruptcies that we've seen and changing the way the restructurings get done.
I think your last point is spot on. Going back a long time ago, and I'm maybe older than you think, Larry, but the rule is always, whoever has the cash runs the restructuring. Yep. That's the way it works. Yep. And it used to be that banks were the guys that were sort of driving the bus, and there wasn't all these other lenders in the capital structure. That's a huge change over the years, and that's what's really driven where companies, they just don't have the ability to go to anybody else and get any financing for running their bankruptcy. So they can't do a reorg. They're basically told kind of what to do by the stakeholders.
Well, so then restructuring is no longer restructuring. It's really more M&A, rescue financing, divest, what have you. Well, thank you very much. Our time's up. Thanks, gentlemen. That was really enlightening. Interesting. Thanks.
Okay, thanks a lot.
Thank you.